Do like, share and subscribe. Bernie Madoff was an American financier and former chairman of the Nasdaq Stock Exchange. He orchestrated one of the most notorious and extensive Ponzi schemes in history, which came to light in December 2008. The scheme, named after him, defrauded thousands of investors out of billions of dollars, making it one of the largest financial frauds ever. Madoff's Ponzi scheme operated for several decades, starting in the early 1990s. A Ponzi scheme is a fraudulent investment operation that pays returns to its investors from their own money or money paid by subsequent investors, rather than from any actual profit earned. The scheme collapses when it becomes difficult to attract new investors or when existing investors request large sums of money to be withdrawn. Here is a detailed description of how the Madoff Ponzi scheme worked. 1. Illusion of legitimacy. Madoff was a well-respected figure in the financial industry and had established a reputation as a successful money manager. He created a sense of exclusivity and limited availability by targeting wealthy individuals, celebrities, and charitable organizations. This lent credibility to his investment firm, Bernard L. Madoff Investment Securities LLC, BLMIS. 2. Fictitious strategy. Madoff claimed to use a unique and highly profitable investment strategy known as a split-strike conversion. He promised consistent, positive returns, even in volatile markets. However, this strategy was entirely fictitious and had no basis in reality. Madoff provided false trading reports and audited financial statements to support his claims. 3. Feeder funds. Madoff attracted investors through a network of feeder funds. These funds acted as intermediaries between individual investors and Madoff's investment firm. Prominent financial institutions, hedge funds, and wealthy individuals funneled money into these feeder funds, believing that they were investing in Madoff's strategy. 4. False account statements. Madoff provided his clients with regular account statements that showed steady, positive returns. These statements were entirely fabricated and did not reflect any actual trading activity or profits. The returns were simply fictional numbers, designed to keep investors satisfied and encourage them to stay in the scheme or attract new investors. 5. Lack of oversight. Madoff took advantage of regulatory loopholes and weak oversight. The Securities and Exchange Commission, SEC, which is responsible for regulating investment advisors, failed to detect the fraudulent activities despite several investigations and tips from concerned individuals. Madoff's reputation and influence within the financial industry likely contributed to the SEC's lack of scrutiny. 6. Continuous cash flow. Instead of using the invested funds for legitimate investments, Madoff used the incoming money from new investors to pay off older investors. This created an illusion of success and consistent returns, further enticing new investors to join the scheme. Only a small portion of the funds received were actually invested, and the rest went towards sustaining the fraudulent operation. 7. Collapse and exposure. The global financial crisis of 2008 put significant pressure on investors to withdraw their funds. As redemption requests increased, Madoff found it increasingly difficult to meet the demands. Eventually, he confessed to his sons that his investment firm was a Ponzi scheme. His sons reported him to the authorities, and on December 11, 2008, Madoff was arrested. The aftermath of the Madoff Ponzi scheme was devastating. It was estimated that investors lost approximately $65 billion in principal investments. Many individuals, charities, and institutions faced severe financial consequences, some even losing their life savings. Madoff was sentenced to 150 years in prison in 2009 for securities fraud, investment advisor fraud, and other charges related to the scheme. The Madoff Ponzi scheme exposed significant shortcomings in regulatory oversight and raised concerns about the credibility of the financial system. It highlighted the need for stronger investor protection.